If you're going to buy a home, most people don't have cash to put down for a home because home prices are going 500,000, 800,000, a million and up, especially in the state of Colorado. So you have to get a loan. And when you get a loan, there's two things that need to be underwritten or approved. One would be the lender's income and what they can afford in a monthly payment, and two would be the actual property. That's what property appraisal is for. But when you're underwriting the affordability of a mortgage for a potential borrower and buyer, mortgage companies look at two ratios. They look at what's called a front-end ratio and a back-end ratio. The front-end ratio is simple. It's basically the only debt you had was your mortgage. How much of your mortgage is taking up your income? So in other words, if your paycheck is, say, $10,000 a month before taxes, and you have a $3,000 a month proposed mortgage payment, you'd be at a 30% debt-to-income ratio on your front-end ratio. Now we have to look at our back-end ratio. The back-end ratio is, okay, if we took all of your debt, credit cards, student loans, car loans, other business loans, that kind of thing, and added them all together, along with the proposed mortgage payment, how much of your income is going to land in that case? So let's say in this scenario, it's $5,000 a month total. Well, now we're at a 50% debt-to-income ratio on the back end. And with a conventional loan, this scenario is fantastic because you want to have your front-end ratio less than 50% debt-to-income, and you want to have your back-end ratio at 50% debt-to-income or less. So in this scenario, both work. Now with FHA loans, VA loans, and USDA loans, those front-end ratios might be a little less, but the back-end ratios may be a little more. So calculating up the loan that's right for you will also depend on what your debt-to-income levels look like. Coffee's ready. The sunrise is beautiful. Become a homeowner. It's good for you, and I'll help you.